Happy Friday. You're hanging out with Sonoma Wealth Advisors. It is Friday, May 30th, 2025, and we're about to go on the markets. My name is Dano Weir. I'm the marketing director for our firm. Whether you're a client, whether you're considering becoming a client, this is our weekly show where we look at the markets, the stock market, the economy. And this week, we're talking about a new term, which might make you laugh, might make you cringe. We're talking about tacos this week. I've got a graph with a huge spike in it. No, it's not the one you're thinking. Spoiler, it's a Social Security chart. There's a new gulf to talk about in the housing market. And believe it or not, you won't find a headline for it, but we actually had a bit of a bullish close to the S&P 500 just a few moments ago. So we will get into all that in a moment. But first, let's start the show. All right, they are managing principals of Sonoma Wealth Advisors, Daren Blonski, CFP, Chris Sipes, CFP. CFP means Certified Financial Planner, and Chris is perhaps a certified taco planner as well. Chris, why are we talking about tacos this week?
Well, it's a good thing you asked, Dan, because even when I brought it up with you guys, I must be getting fed something through my algorithm that you're not, which is a feature of modern life that we can all live in our own realities based on whatever the social media gods want to feed us, right? But this is a reference to an interview earlier this week, or I guess a reporter asked President Trump how he was reacting to the so-called taco trade on Wall Street. And he says, what are you talking about, basically? And you can look this up. It's like a 30-second clip. She says, well, the Wall Streeters are calling it the Trump always chickens out trade, meaning that, buy the dip because the market's going to go down whenever the tariffs are announced, but then they're going to be pulled back. And so as you can probably imagine, President Trump didn't love that question. And just a couple of days later, we get the I guess it's called a truth when you put something out on Truth Social. He put that out that he was getting tough again with China and on the tariffs. But just like a repeat of last week, it seems like the market doesn't really care anymore, because they also announced, the 50% tariffs on the EU last week, and the market was like, yeah, right, not going to happen. And it seems like we're getting kind of the same reaction today. So believe the market.
It's an interesting, and so some other things which happened this week in and around tariffs. There was who knew that there was a court of international trade in the United States? We're finding about all these corners of the federal government that we didn't know, who ruled that he, in fact, couldn't be levying the tariffs that he was with his emergency powers. That has then been appealed and stayed, at least for the moment. So there's a few things that have happened in and around tariffs this week. And I thought that the phrase, not only did I just want an excuse to talk about tacos, if you're feeling like there's really there's how do I say this very nicely? If you're feeling like things are going all one way, the taco idea is actually interesting because it's an indication that Trump has said very intense things, and there's been a few instances of him actually backing off of them, Daren.
There has been a few instances, when I saw this headline, because this is really interesting. Like, Chris, I would venture to say that you and I probably read most of the same news sources or very similar within range. And I missed the taco outburst, let's call it, this week. And so when everyone started talking tacos and these memes started flying, I'm like, what? Who said what now? And so I went back and I watched the actual press conference where the reporter, I believe the person was from CNN, which probably inflamed Trump because he doesn't seem to like CNN, but it was a Financial Times reporter that I went back and listened to an interview with him. And it's hard not to hear a lot of bias through whoever you listen to on whatever side of the aisle. And I was telling Chris and I were talking earlier, like, it's amazing now that like moderate and willing to look at both sides of it is like the weird thing now.
Right.
And, but when it comes to investing, like if you're not doing that, you're in trouble. Like you're going to wreck your portfolio.
Absolutely. I think it was Jeff Bezos who said something to the effect of, one of the best things you can do in business is, instead of trying to think about all the things that are going to change and trying to be the person that does those changes, more say to yourself, what is going to stay the same and how can I benefit on that? Right. So inverting that thought, which when it comes to the national debt and the finances of the government, it's hard not to just bet things are going to stay the same. And, as they roll out this new budget and, it looks as of now, like there's not going to be a lot of changes in terms of the debt and the deficit. Maybe that's why the market's been rallying. I don't know. But I think that it's very interesting when it comes to the treasury debt. How much does this affect the treasury debt? Because Ben Carlson at Ritholtz has pointed out, like, look, we had much higher interest rates in the 80s and in the 90s when our national debt was way, way lower as a percentage of our GDP. Our deficits were lower. And so now we've got way larger deficits, way larger debt, and our interest rates are actually lower than they were at that time. So I don't know how much, correlation there is between the debt and the deficits and then your interest rates, but it seems like there might be a little more overreaction, I guess, going on in the bond market when you look at it that way.
Chris, speaking of tacos, right? Like, we had all this hype going on for many months up until this point with this new administration about Doge and cutting expenses and blah, 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 right? And the new budget, what do they call it? The big, beautiful bill comes out and it just adds to the deficit, right? Like it doesn't actually achieve what everyone's been saying they're going to do. It's just a further prolonging government spending. And I go back to what you and I have said over and over and over on this show. It doesn't matter what side, like they both have to perpetuate spending. And one side likes to say, oh, they spend more than me. And the other side says, oh, they spend more than me. But at the end of the day, unfortunately for the United States of America, we are on an unsustainable course that I don't know that we can get off when it comes to spending, because we have our the best thing I can the way to think about it is you look at like a kid who's addicted to technology. Like we're addicted to spending. We're addicted to monetary stimulus, fiscal stimulus now. And I just don't think because Chris, yesterday you're saying to me, like, I don't get it. Like all these bad economic data is coming out, like the market just doesn't care. And I think it fundamentally just comes back to a simple truth. And that is that the market completely believes that the government is going to step in and bail everything out. And until that changes, until we see something different, I think that's a pretty good thesis. And the market doesn't lie, right? And I think that's why you see a bullish close today. And I'll show you when I dig into the charts. We got a bullish close, even amidst all this tariff junk going on.
And I've just because we need to keep talking about tacos. I think it's interesting for someone who, as quote Liberation Day, the tariffs are happening, as many things have happened with the administration, and it feels like, especially if you're not someone who voted for President Trump, it feels like the floor is being pulled out from under you. And there are things changing. I'm not discounting things that are changing. But this is a perfect example of just because something is announced and just because, quote, experts or other people or people standing to the side of him say yes, yes, doesn't necessarily mean that it's going to happen and doesn't necessarily mean that it's going to play out how they say it's going to play out. So what that can mean for you moving forward as, further developments are going to happen is perhaps check, if you can, check your emotion and try to make sure you check in with your advisor, because if you just go all on emotion and go all on what someone says on TV, you're going to end up with whiplash in your portfolio.
Yeah, I think it's hard to interpret the market any other way than saying like the market is not too keen on the tariffs. Like when every time that the cans kick down the road, the pauses come, the market rallies. When that court order was announced, the market rallied. The futures were up significantly when that happened, and then when they get reannounced, like earlier today, the market was down. Midday based on the tweets about more to come with China. So but to your point, Dan, I think you have to go with what the market is saying, is that these are not going to be implemented, and at least for the time being, knowing what it knows today, it seems to be looking past those tariffs. Now, we got a big increase in bullish sentiment this week. Emotions follow price, of course. Look at where we were to start the month versus where we're ending the month. We had a really good May in the markets, a lot of recovery. And so along with that, bullishness is ticking up, bearishness is going down. We're off of some of those bearish highs that we saw in April coming into the trade wars. Now, the fear and greed index from CNN, which is more of a positioning index, shows 62, which is about the same as it was last week at 63. Bitcoin down to 60, which is still greed, but down from 78 extreme greed last week. With, we saw a brief breakthrough for the all-time highs in Bitcoin, and it's since sold off. So Bitcoin continues to be kind of the tip of the spear when it comes to the risk in the markets and the market's appetite for risk. We saw Bitcoin rally prior to the market rallying, and now we've seen it sell off the last week or so. Not dramatically, but it's off of the highs. I think it was like maybe 111, 112, somewhere around there. Now we're down in the neighborhood of 105. So it's really interesting to me how that seems to be the telltale for the rest of the risk markets.
I'm sure Daren will have no slides and no graphs to show in refute of what you just said. So no response. Daren has no response to whatever you
zero.
We can only hope, right, Dan? We can only hope.
Yes. Darren's mic got cut off. Oh, weird.
Yeah, absolutely. So the outperformance in foreign stocks continues to be the case this year. We're almost halfway through the year now, and you can see the European. So you kind of break down the international stocks into two camps. You've got the quote unquote developed markets, and then you've got the quote unquote emerging markets. And there's different countries kind of lumped into the different markets. And then you've got some that just look at it as basically the USA and everything else. And so that's why it's broken down this way, to show you that. So U.S. stocks continue to struggle. However, they've kind of, got back to even for the year. And on pretty much every valuation metric out there, they are still very expensive as a group relative to history, and where their valuations have been in the past. So kind of interesting that you're seeing all these headwinds, and yet people still are willing to pay a premium for U.S. stocks. Maybe that's recency bias. Maybe, it's justified. Who knows? But we are about halfway through the year and seeing a pretty dramatic shift in where the performance is coming globally this year.
And Chris, the European run so far this year has been so helpful to me as someone who, if you don't know, I'm newer to the firm. I'm not an advisor. I'm the marketing director. And so I'm learning along with you, the audience, about all this stuff. And it's when that graph where you show Europe hit an all-time high in 2007, and then it's just this march down, 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 down. And now, boom, out of nowhere, right? A great run back up to all-time highs is such a perfect example of why you need something in your portfolio that sucks if you want to be a diversified investor. Because look what it did. And in those years of 2008, 9, 10, 11, 12, 13, 14, it's all going down. And if you were talking to your advisor, you'd be like, why do I own this? This is not working. In 8 years, it's not working. And then all of a sudden now, for no reason, at a time when it shouldn't be, it's, going gangbusters.
That's the case. And most people don't know that there have been several times in history where the US stock market even has gone nowhere for 10 years, 15 years. In the case of the Great Depression, it was over 20 years. And so that has happened in pretty much every major stock market around the world. And so if you fall victim to what they call home country bias, which is we all have a bias for the companies that we know and love and spend our money at. I mean, who doesn't love owning, Costco stock or something when you're like, gosh, I go there all the time and spend, all kinds of money there. It makes me feel comfortable over owning some company that I don't do business with, right? But the downside of that is, imagine yourself as a European investor and you say, hey, I'm just going to only stick with European stocks. Well, you would have had no returns over the last 20 years almost, right? So you would have had those lost decades. And anybody who's concentrated is more at risk of getting of falling into that same trap of lost decades. And so that's why you diversify and own those other countries, even when you think there's nothing that's going to happen. Because imagine going to the beginning of the year, I can't think of anybody that told you, hey, European stocks are going to outperform this year. They're going to be the place to be due to US policy or anything else, right? Nobody would have believed you. So, and that might be the case with the bond market right now, because everybody hates bonds. They've been in a bear market for, several years at this point. They just went through the worst, bond market in history in 2022 and 2023. Never seen anything like it. They've just been bombed out. People hate having bonds, right? And with all this talk of the fiscal profligacy of the United States government, nobody wants to own bonds going forward because of the fear that our government finances are out of control, et cetera, et cetera, et cetera. So, but usually, when asset classes are left for dead, nobody wants them, that might be the time to just consider having them as a diversifier. And here's why. And the longer this chart illustrates the different reactions of time periods on bonds.
Yeah. Dan, do you like how Chris had to phrase that when he said, hey, you might want to think about maybe owning a bond in your portfolio. Even Chris at this point is like, maybe you should, because literally, if you say bonds too loudly to some investors, they lose their mind.
Yes. That's partially
gently, kind of. If I draw the graph out a large enough time frame, there was success at one point.
That's right. Well, and the kind of most basic thing to know about the bond market is that the longer you go out in term, because you can buy short-term bonds, you can buy medium-term bonds, which they kind of term like 5 to 10 years, and you can buy long-term bonds up to 30 years in the US. The longer you go out, the more impact changes in interest rates have. So look at the one that's highlighted there, the 30-year Treasury. And you can note that if interest rates go up by 1%, you're probably going to lose about 11% off of the value of your bonds, which anybody that's owned bonds over the last 3 years are intimately familiar with that situation. Now look at the flip side of it, though. If interest rates fall by 1%, then 20.8% is the likely upside in that situation, right? No change is just what the coupon is. That's just what you're going to get in interest, right? And so something to know as a bond investor is the longer that you go out, the more volatility that you're accepting, and the more sensitive that bond is going to be to changes in interest rates, both positive and negative.
Should I make a football analogy or should we just skip to the next slide?
Bonds and a football analogy all in one conversation. We're going to lose Daren any moment.
So not that you should do this, but if you were to be perhaps choosing who you think is going to win the Super Bowl this year, a very safe bet for like the next 30 years to win a Super Bowl would be the Pittsburgh Steelers. Because if you go out long enough, over a long enough time frame, they've won 6 and they've been consistently very good. However, for the last 10 years, they've been absolutely dreadful. They've been 500. They've had quarterback problems. There's been all kinds of issues. Extremely boring team at this point. But if you go out long enough, that would probably be a good choice. But a much easier pick would be like the sexy new tech stock, which would be like the Chiefs, which they've won a ton recently. They've got a lot of like buzz around them. But at some point that ends. And at another point, the team that has been consistently good for a really long time is probably, you know, this, I don't want to say safer. You would have maybe a better chance choosing them than something who's new and hot. So I don't know. I don't know if that resonates or anybody, but that's kind of how
I followed you. Yeah. Some good news in the market. We got the PCE, the personal consumption expenditures, and that came in right in line with expectations. Now, this is important because it's considered a metric that the Fed follows closely to anticipate what's going to happen with inflation. And so it looks as though the inflation numbers are continuing to tame. Trueflation, same thing, you know. So if you're someone who's like, well, I don't believe anything the government puts out, if you look at the trueflation numbers, kind of similar. So I think it's hotly debated as to whether the tariffs would be inflationary or deflationary. Inflationary because the prices of everything go up, deflationary because people would actually spend less on those items if they're more expensive. So I think I fall into the deflationary camp. I believe Daren agrees with me on that one, but who knows, right? Strong opinions loosely held, right? Because you got to be ready to pivot to what the market is going to do at any minute. Now, we saw a huge drop off in like the incoming goods last month, and you'd think, oh gosh, wouldn't that like affect the economic numbers more? You would think so, yes, but this little dandy came out this week, which was the personal income transfer payments outside of the off the charts spending that we saw during the great financial crisis and COVID. This was a pretty high transfer payments this week. So it's like, well, what gives? A lot of people were saying, why the spike in the transfer payments? And Kathy Jones from Schwab answered with the correct answer. It was driven by one-time payments of Social Security benefits under the new Social Security Fairness Act. And so that was some of the catch-ups that were due for folks that missed out on the pension adjustments, I believe. And so if you're someone that thought you don't qualify for Social Security for whatever reason, you might want to double check that. A lot of people are finding that has changed with some of these recent changes in Social Security. So in terms of the market, in terms of the economy, this last month, there was a lot papered over by these transfer payments that came in last month, which you can see here. This is from the Fed, showing the spike in those transfer payments was relatively large going back to 1985. This was a big transfer that happened in April. So,
and this was the windfall elimination provision?
I believe so, yes, as part of that Fairness Act. This happened to be the largest year-over-year increase in the Social Security benefits since the inflation was contained in 1982. So it's a big change. Now, speaking of diversifications, one asset class that a lot of folks use for diversification because it's not correlated to stocks or to bonds is trend following. And it's kind of it's an eccentric asset class. Not everybody knows about it. It's difficult to understand how it works, et cetera, et cetera.
Eccentric. Come on, man. Like, whose side are you on? Trend following, cool.
I think it's cool, for sure, but not a lot of people are familiar with it. So trying to do some education here. This is Meb from Meb Faber, but by way of Katie Kaminsky. And she says the SG Trend Index, which is sort of like the S&P 500 index, but for trend following. So it's like, what if, they're all like having their individual returns, but if you kind of mesh them together as this average in the SG Trend Index, is how it's measured. It's down 18.7% for the 1 year period ended April 30th of 25. So a pretty bad year. That's the worst 12-month return of the index's 25-year history. So that's the bad news. You can see it kind of falling off the chart there. But the good news is that you can see prior times when that has happened, typically the returns moving forward, kind of like any asset class, gosh, you get a washout, tends to be a good forward return expectation in that situation. So Katie shows that the times where it's done really, really well, and the most recent being in 2022 during the rising interest rate environment when stocks and bonds were both down in 22 and trend had one of its best years. So following those awful years, trend in the past, not a guarantee or even indicative of future returns, but in the past, the subsequent 1 year performance of trend has been very good historically. So if you're kind of looking at those in your portfolio, and I know a lot of people are going, gosh, they've kind of taken the place of bonds. Like, why do I own these things? Well, here's one reason why you might want to consider owning them in the future.
How does this work, Chris? What even is this? What is it? What are they following?
It depends on the fund, but they can follow trends in stocks, in bonds, in commodities, in interest rates. They all have different time frames that they're looking for and ways that they look for those trends. And some of them are short-term trends, medium-term trends, long-term trends. So it really depends on the fund. Some are what they call long only, where you just you're not shorting anything, betting on it going down, and some are long short. So it's different for each fund, both in the asset classes that they trade and also how they trade them. So it depends.
Yeah. I just think looking at this, especially if you're retired and you're always wondering like, oh, how do I get that number up? How do I get that return up? I mean, look at some of these 44, 25, 37. Who doesn't want to see that number at the end of the year? Look at the dark blue. Are you cool? Are you chill with 20.8 negative? Are you chill being down 17%? This to me, Chris, just looks like, a great measure of, can you look at this and tell me about your volatility? Tell me about how much you really are cool with risk, because that looks like that looks like risk on a stick.
Well, and if you took the label off of that and said, okay, it's not the SG trend index, but it's say the S&P 500, something that people were actually familiar with, they go, oh yeah, sure, I'm fine with that. But you put a label on of trend, SG trend, and people are like, I don't think so. I don't think I'm good with that kind of risk, right? Because we naturally, if we don't understand something, we don't understand how it works, et cetera, it feels more risky than something we're familiar with and we feel like we understand.
Yeah.
So that's a big piece of it. So Daren, you sent this over from Redfin. There are nearly 500,000 more sellers in the real estate market than buyers at the moment. Now, this looks like it is the kind of largest such, dislocation in this direction, at least. I mean, look at that dislocation in 21, 22 during COVID. Oh my goodness. So many more buyers than sellers, but now that's flipped. So you wonder what's happening in the real estate market. This seems like pretty like a big thing, right? And if you've got more sellers than buyers, that's going to put pressure on housing prices, right?
Mm-hmm.
You would expect.
I mean, I don't know. This is just me surmising, but the affordability of homes alone is going to make buyers just say, meh, I don't know. I'll stick where I'm at, right? Versus the sellers, who people are starting to pile up. And I've noticed this. I just like to look at Zillow, and if I'm traveling or in a different town, I look at Zillows and look at the house prices and whatnot. And just anecdotally, the number of price cuts on Zillow has been significantly more than I've seen in a very long time.
Yeah, agree.
Not the demand.
Yeah, the buyers have really stayed the same since the interest rates went up, and you can see we've been basically like trending down a little bit, but pretty much sideways in the buyers since interest rates went as high as they are. And we update client values as part of their financial plan, and I would agree with you. The Zillow values on most people's homes are dropping, so it's. Who knows if it's the beginning of a trend, but we all know that they're extremely expensive relative to where they've been historically. So it would be kind of a welcome reprieve for the buyers, at least in terms of getting an opportunity to purchase a home.
And this is just, I mean, shot in the dark, but the people to see a spike in this much in people who are selling, I would wonder why they're selling, and I would wonder if they're like liquidating their house, because if they're selling, wouldn't they also be a buyer as well? Because they're probably going to go move into something unless they're going to go become a renter.
Not necessarily, right? Because you could be having people who just can't afford what they bought, right? And we could also be seeing a wave of people who have bought in the last 3 years expecting rates to go down. So maybe they bought more than they could afford because the affordability went up when rates went up, or the affordability went down when rates went up. And they're like, well, I think rates are going to come down, so I just hold on for a couple of years, and maybe they're getting to the end of that line too. So that could be also enforcing sellers into the marketplace.
That's kind of what I was wondering. I was wondering if this is people who are just finally like over their head and they're like, I got to get rid of this thing. Right. And and we've seen credit card debt all the way through the roof. I mean, all kinds of, auto loan defaults are up. I wonder if just then now, well, put the house on the market. I got to liquidate that for other reasons in your financial life.
I think we see the evidence all over the place that generally the average consumer is stressed, right? The average consumer is struggling, and, they like to tout, hey, the price of eggs are down, but has inflation really come down? I don't think so, right? At least not in the basket of goods and services I buy on a regular basis. So I think the consumer is, in fact, more stressed, and I think you see that, and this is an indication of that.
Yeah. And so what's the housing supply say about this? Well, we've covered this where the supply of new single family homes has just totally decoupled from the existing homes. And that's, because people with existing mortgages and they've owned the house forever, and, people that have own their home free and clear for a long period of time. They don't have much of a reason to sell. And so we've seen this disconnecting of the existing and new home sales or month supply. So we've got 7 months of new single family homes, 7.3, and 4.4 of existing. Under 4 is considered a tight market. So it's a seller's market. Between 4 and 6 is a pretty balanced. So prices should stay pretty neutral in that scenario. And then over 6 is considered kind of a loose or a buyer's market where the prices are starting to come down. So on those new single family homes, you would expect to see those prices dropping a bit. I don't know how it works with the average here, given that, the average is going to show you like what the overall supply of homes is. I wish I had that number, but I would assume it's kind of in that 4 to 6 months of balanced, prices staying the same to dropping a bit. And this is just showing the previous 4 quarters nationally, what happened with home prices. This is from MBA research. And you can see by state, the changes in home prices. And on average for the U.S., house prices have changed 4% across the U.S., with a lot of that increase coming from kind of like outside of the hot states from COVID. Not much in Florida, not much in Texas. I remember Idaho was a hot place to go. Now most of those price increases are in the Midwest and on the East Coast. That's it for this week on my side of the slides, guys.
All right. So, guys, what if I told you that, I think, Dan, you kind of teased when we started off the show, but what if I told you that the bullish close in the market had everything to do with the low of COVID?
Would not believe you.
You wouldn't, but sure enough, it does. So check it out. So this is the low of COVID right here, March 23rd, 2020. There we go. So you can see us right here, March 23rd, 2020. That was the low, and this is a trend line on the S&P 500. This is the SPX, so this trades a little more frequently than what SPY does, and because you can actually trade the S&P 500 around the world. So it has in theory, a more consistent chart to it because it has less restrictive trading times. But SPX here, you can see this was the low. And you can see during the COVID era of all the money printing, why we're still sitting in our houses for this first chunk. And it went way up and then hit this all-time high January 3rd, 2022, right before all the Federal Reserve decided that they would now put all their investments and their trading behavior behind blind trust, and no longer we're going to trade the market. And then that turned out to be all-time high. And then the market moved down in 2022, and this was the low of 2022. And that was in October 10th, 2022. And you can see that was this era. This is area, I believe, this was right when they came out with the vaccine. There was all this hubbub about the vaccine right here. And then sure enough, we got a magical vaccine. And then market took off. It came back in 2022, was the low. And then the market started climbing back up. And in March of this year, the May low for this year was May 7th. April 14th was the low. And interestingly enough, that low was the high before the 2022 market correction. And so we came in April and traded down into that 2022, came back up and retraced this. And when we look at our fib lines on how much the market retraced, you can see here, we're now above 75%. So bullish because we held that this week but even more bullish because you can see this blue line right here. That blue dotted line represents the trend line going all the way back to the low from COVID. And you can see when we trade up above that, 2022 came in, we started correcting, hitting that and getting rejected off this trend line going up, and then finally broke above it right here and have been up above it until recently where we went back below it, and now we're back above it. So the fact that we're back above this trend line, that's pretty bullish on its face, because that's an important anchor point, psychological for the market. It goes all the way back. So from the fact that we maintained a 75% retracement, from the fact that we closed now back above the blue line, that's positive. We also had a double top in the formation. So you can see this. So that now we're looking at the 4-hour chart on the SPX. So every one of these bars represents 4 hours in the market. And you can see this double top formed, and it came right back in as the neckline is this blue trend line. And that same blue dotted line there is the same trend line all the way back from COVID, which is pretty amazing. And the market came in, and interestingly enough, it gapped above it. That was Monday, May 12th. It gapped above it, stayed above it, came back in, lost it. And you can see 3 day or 4 hour segments here. It just sat on that trend line, went below it, but quickly traded back above it, came back in today, early on in the day, in this candlestick right here, tested it, and then traded up and bounced above it. So if you look at this on the hourly chart, you can see this even clearer. You can see earlier in the day, it came in, found support, and went above it. Again, this blue line represents the trend line going all the way back to the COVID low, which is pretty amazing that the market's still queuing off that point, and tells you how important that point is psychologically for the market. And then we traded and we found support right there. Support just means that the buyer stepped in, and then the market traded up and closed up the day in a pretty, I would say, bullish stance. Couple good things here, right? We didn't lose this area today. We actually found support in it. Had we lost that area, then we would have traded down in and probably tried to close out this gap right here that was on the chart. I'll make that look a little bit cleaner here. So on the chart, there's a gap, that happened on the 12th. The market likes to close gaps. It hasn't fully completed the gap close. So it won't be surprising to me if we do at some point try to close out this gap here. We almost had it closed right here, but not completely. So I think that's interesting. So on its face, you can't look at that in any other way but say that's bullish. Now, what's even more interesting, if we go back to a monthly chart, in this blue line, this is that same blue line I'm talking about that was really, really important in a short time frame today. Based upon this, I think you would be very foolish to bet against this market right now, because the way this chart is lining up, it's about to rip your face off. And the fact that we closed back above that blue line today looks pretty positive.
Rip your face off is a good thing, right?
Yeah.
Well,
this is a term of like the idea of like, if you're frowning right now on this market, you're about to be left in the dust. That's what this market's saying to me. And the reason is because you see this on a monthly chart, you see this huge candlestick test here of this 2022 high. And then this follow through candle that's, at least so far, very green. And the fact that the weekly, we're basically going to close the month up now above that blue trend line, because we're at 530 right now. And that monthly candle is going to look pretty bullish. The fact that we traded up here and we closed. The only thing I don't like about it is we didn't close higher than the monthly candle from March. But the fact that we made it above and the market felt important to close above that blue line, I think that's pretty bullish on its face. I don't think you can argue it any other way. And I think it would be a mistake not to be bullish on the S&P 500 at this time. So take that for what it's worth, whether it fits with your politics or not. The reality is the market looks like it wants to go higher. Now, what do we have to contend with? I was talking to an individual yesterday, and we were talking about how right now is a very dangerous time in the market. And here's why. So now let me argue the other side a little bit. So this was the all-time high in this area on a daily chart. And we traded up here, and the all-time high was basically right around 6,000. We poked our head above it 3 times and then went back down, and then found our low down here in the 2022 at 4,800. And now we're almost back. We don't have very far to go right now. From where we're at today, we're basically, we'll call it 3.86% away from or call it 4 away from the all-time high. So the trying to jump into this market right now and bet that it's not really a great time, because worst case scenario, we go up and we bounce back down, and then you invested right at the top of this area. At this point, you might as well wait for the market to break out above 6,000 and prove that, and then take a position if you're on the fence. Because the other thing that is still possible is we actually roll back over, right? Because so here's our Fibonacci and our retracement lines, and you can see we're right in this 75 range here. But it's still possible at this juncture that we just did a really strong retrace, and now we're going to get in more tariff fights or whatever, we bomb Iran, I don't know, whatever the latest du jour is. And then we continue downward. The other thing to look at is, and this is interesting too, so this is that long-term COVID line here. That's that trend line from COVID. And then you take this all-time high and trend line on the most recent rejections, and you can see we're getting this kind of ascending triangle, which means we're approaching some type of breakout. Like buyers, sellers are getting closer. And so either it's going to drop down hard and it will actually close out that gap there that's still in the chart, or it's going to break out and try and take on the all-time high. So we're kind of in no man's land, but I think it's leaning bullish at this point. The fact that the monthly chart's going to close up where it's going to close up, I think it'd be foolish to be sitting at home betting against this market. All right. So that's the S&P 500. And I think generally a pretty decent close. Let's look at the gold charts. Gold's getting ready to make its next move. You can see this descending triangle in the gold chart right here, where price is descending, and the buyers and sellers are getting closer and closer, and then we'll break out at some point. Let's see the 10-year. Let's look at the 10-year. Rates went up this week. We're still sitting on this kind of support line of resistance or support on the 10-year bond. Watching this for our bond people out there. Chris is like holding on by the edge of his seat, sweating bullets that the 10-year yield doesn't go up. But bonds, the 10-year yield was down today, and so therefore bonds are up. But
I'm hoping not to get my face ripped off by interest rates.
No, you're hoping not to get your face ripped off by interest rates, but you're hoping that you actually do get your face ripped off by the bonds. Chris, when bonds rip our faces off, we'll let you do your victory lap. We'll even get you a cake, okay?
I do a ton of work for the firm on like vision and marketing and like like things that are important to the company and values. I'm going to add ripping off faces as a new key value. We aim to get you a portfolio that's going to rip your face off.
Did I send you guys that it was this linguistic guy, and he was doing like a graduation speech?
Yes.
It was hilarious. And it
on God for real.
Yeah, it was hilarious. There's all the slang terms that this generation uses. And this guy did a whole like graduation speech in it. It was hilarious because having teenagers and listening to their friends talk, and I'm like, well, yeah, that's actually what they say.
No cap.
Need an interpreter. Yeah, well, just for the record, it's highly unlikely that bonds are ever going to rip your face off, even if they're doing well. So don't hold your breath.
Financial humor, right? This is the Qs, just taking a look at the Qs and technology. You can see we're just flirting with these all-time highs. We're right there. And you really want to just sit tight at this point, and watch and see if the market can prove itself. The retracement is in. If you pulled out down here and then didn't get back in, at this point, like you might as well just wait for it to break out. But this is why we always say, like, you just ride it, right? Because these tend to get these, especially nowadays, you tend to get these huge retracements that happen very quickly. Let's look at the mags, because the mags is such a huge portion of the market. Magnificent Seven, for those who don't know, mag sevens are super important from overall volume in the market. And this is looked at visually here when you see our mag sevens are such a big part of the market. They're so big. I mean, NVIDIA is bigger than the whole financial sector almost. So if not bigger, almost bigger. But Microsoft certainly is. This is over here. This is the entire utilities sector, and it's like half the size of NVIDIA and Microsoft alone, let alone the energy sector over here. Microsoft and NVIDIA are twice the size of the energy sectors. And that's just wacky, right? Eventually this is going to get rebalanced, but right until that happens, these are super important if you want the market to keep going up. It's pretty critical. So we're watching MAGs, which is an index that tracks that ETF. And you can see we broke above that downtrend and we actually held it. So after today, I'm going to say the MAGs are bullish. How you like them apples? So you can see the breakout, the retest, and the resumption upwards. So Chris, I hate to say it, buddy, but I think we're going to see some mag movement, not MAGA movement, mag movement. And that will draw the whole market higher, which then goes into my thesis, the fact that, oh, look, this looks positive. Well, that makes sense because MAGs is positive. It doesn't mean we might not still go to a recession, right? Because we all know that the market is not the economy and the economy is not the market.
What about Bitcoin?
Oh, I knew you would ask, Dan. I knew you would ask.
Well, I teased it.
You did tease it. And check this out, right? So this is the all-time highs. And I'm a little on the fence. I think it's
We lost your screen. We lost your screen.
Oh, here we go. All right. So here's the Bitcoin chart. And you can see it was an all-time double, or it was basically a double top type formation there. And it went down, came back in, moved up very quickly. And you can see it's hard to read for sure because we still have 3 hours before the Bitcoin chart will close for the day, or the candlestick. I don't particularly love it at the moment. The fact that it's holding support right here, I like. You can see right this support area, and you can see where it's just sitting. The fact that it broke out, got rejected, broke out, got rejected, and came back under, I don't think that looks particularly great for the Bitcoin chart in the short term. There could be more downside there. I would see a test of 100,000. It did kind of test it, came in, tested, went up, came back. If it doesn't hold above here in 3 hours, then we could very likely see a $100,000 test. But the longer it holds that $100,000, the more likely it's just going to roll higher because your buyers are just hanging out here, buying. And like I always say, there's only 21 million Bitcoin, so finite supply, eventually demand takes it in. So overall, okay, but I'm a little on the fence with that chart at the moment. All right, well, I think we're just going to leave it there. We did a deep dive into the S&P 500 today, and I think generally it's bullish, and generally it's a rip your face off type of thing going on. And watch out. Don't bet against the market up and to the right.
Look for a future episode to be titled Rip Your Face Off. But this week it was all about tacos. And what a good day to do it, too. I think I may get that for dinner. We are Sonoma Wealth Advisors, and this is On the Markets. So thank you so much for hanging out with Daren Blonski, CFP, Chris Sipes, CFP, myself, Dano. If you're a client, if you're a prospective client, you can learn more about us at sonomawealth.com. You can take our free wealth analysis. Wherever you're checking out this show, make sure to like and subscribe. We appreciate that. It does help us. It helps the show. And, of course, we're on YouTube, we're on Apple, and we're on Spotify. We make it easy for you to find us. So we will leave it there for this week, and we will see you next week. Thanks so much.